Welcome to January Market Review. Today we're going to go through three main points. Equity markets have seen an increase, but performance varies across region. Going to the sub-points, while developed markets show an overall increase, not all of them performed equally. The emerging markets experienced a significant decline due to negative sentiments about China's economy, but the impact was actually partially offset for dimensional funds by the resilience of value stocks. The second point, fixed income declined slightly as yields in developed market experienced a slight increase. And finally, worries emerged again regarding US regional banks, but the impact was actually quite asymmetric across the index and dimensional funds. Going into the numbers for market index performance in January, I'm going to start from the right-hand side in fixed income first. Now, the Bloomberg Global Aggregate Bond Index actually fell by 0.2%. The reason very simple, it's because yield went up slightly, and we all know the inverse relationship between yield and bond price. As yields goes up, bond falls. Now next, if we look at the MSCI emerging market, it fell by quite a substantial percentage, which is a 4.2%, mainly because of negative sentiments in China. What happened in China? We are seeing a deflation situation. In fact, in December, there was another report of a deflation, which is for the third consecutive months. On top of that, there are concerns on China's property sector. And in fact, China's property sector makes up China's GDP of about 30%. And the MSCI emerging market has about 25%, slightly above 25% weighting in China. And therefore, what we are seeing here is the majority of the impact actually comes from that region. The S&P 500 index, representative of the US top 500 companies, went up by 1.68%. Now this number mainly is lifted by the Magnificent Seven again due to the AI optimism spilling over from December. On the MSCI All Country World Index, we are seeing 0.23%. Now that's because it's lifted by the developed markets performance, but also dragged down by the emerging market. So overall, it still have a positive return. Now, if we go into the MSCI World IMI Index, which only holds the developed markets, of course, this 0.77% is contributed by the US market. However, on top of that, we are seeing Europe also showing positive performance. But in the UK, it's a different story. There's actually a negative performance. Now, if we go to the next slide, you can see here, okay, as I mentioned just now, in the Europe region, their indices actually showed that the performance that we are seeing here for the Europe indexes is positive. However, in the United Kingdom, we are seeing a negative 1.33% fall. Okay, why is that so? Now, that's because in the UK, recently it has just reported their retail sales numbers, which were quite disappointing. And on top of that, this notion was actually reinforced after Burberry, the UK fashion house, actually also reported disappointing retail sales number and also forecasted a weakening sales ahead. As a result, the FTSE 100 UK actually fell. Now, if we go into the specifics of the Europe, for example, looking at France, recently the corporate results in Europe was actually quite positive, and particularly the LMVH Paris, the France luxury fashion brand actually reported a strong retail sales number. and it went up by about 1.5%. Now, as a result, you can see even for the regions that is in close proximity, their performance can vary. And therefore, it is very important to have that diversification to be able to capture the parts where the returns are there, and as well as diversification that mitigates certain areas that have negative performance in different time periods. So if you look at this slide, which compares the LVMH and Burberry share price year-to-date percentage change in January, you can see that Burberry Group actually fell 7.6%, and the LVMH actually went up by 5.5%. Going into dimensional equity funds performance, you can see that dimensional global core equity, the world equity, and the dimensional global targeted value were all in the negative region. Specifically, the global targeted value is actually at negative 2.3%. Now, the reason for this is because of dimensional's value, tilt, and size strategy, which underweights large growth stocks and overweights small cap value stocks. And the consequence in this month is because that the large growth companies like the Magnificent Seven actually were the ones that were driving the performance. And as a result, the underweighting actually resulted in a underperformance against the indexes. And on top of that, on the final day of January, worries about US regional bank resurfaced again. And as a result, the US regional bank stocks actually fell quite substantially. Because they are mainly value and size small cap stocks, as it actually had a negative performance on the dimensional fund as well. And if we look at the dimensional emerging market, it actually went down by about 3.4%. Now, even though it is actually also in the negative region, the dimensional emerging market actually outperformed the MSCI emerging indexes by about 1%. Now, that's because in the emerging market, value actually outperformed growth, and therefore the dimensional emerging market actually outperformed the indexes as well. Now, I'm going to hand this over to Zhihan, who will be talking more about the benefits of diversification. Thank you.
Thank you so much, Chun Xiong, for the market update, and welcome everyone. So if there is one observation that we can make out of the market update that Chun Xiong gave, it is actually the importance of diversification. So this chart behind me, this very messy chart, it really depicts the importance of diversification. So it actually shows the various returns of various countries in the developed market. So how do we actually read this chart over here? So in 2003, right, Sweden, they are actually the top performer, posing a return of 64.5%. Germany, 63.8%, and Spain, 58.5%. Finland is the worst performer, 19.4%. And each individual country, they are depicted in their own unique color. So when we look at the larger picture from 2003 all the way up to 2022, do we see a certain pattern to it? If you are trying very hard, may I just advise you that, there's actually no pattern to it. So this clearly shows that returns across various countries is actually random. Okay, it is actually the same in the emerging markets. It is also the same in the various sectors, communication services, consumer discretionaries, energy, consumer staples, etc., etc. The returns in the various sectors in the different years is actually random as well, right? So this shows us the returns, the compound average return from 2008 all the way to 2021. Should I be invested in the MSCI All Country World Index during this period? My return will be a very respectable 7.3% annualized per year, right? If let's say I were to exclude the top 10% of the performers every year, my returns actually dropped to 2.5%. And if I were to exclude the top 25%, I will be creeping into the negative territory. So there is no reliable way of predicting which country or which sector will be the top performer. Hence, it is very important to diversify our investments. So it is not uncommon that you hear your friends, family members, or even experts or financial advisors telling you that you should be invested in the S&P 500. It is true. We should include the S&P 500 into our portfolio as a form of diversification. However, we should not just invest into the S&P 500 alone. If we were to look at the returns generated from January 2014 to December 2023, the cumulative return of the S&P 500 during this period was a very respectable 211%, right? However, what many people fail to realize is that there is actually a lost decade in the S&P 500 as well. From January 2000 to December 2009, the return was actually negative 9.1%. So should you be invested in the S&P 500 only during this period in time? Even after holding on for 10 years, you would still be making a loss, right? And I also understand the allure of having home biasness in our portfolio. I mean, we are familiar with the local companies, hence we are more comfortable investing into local stocks, right? So should we just be invested in the STI index? From 2014 to 2023, the returns is only 2.1%. And the decade before that, from January 2000 to December 2009, the cumulative return is only 11.1%. But should I be invested in the indexes all around? You can see that returns are generally random but very respectable. Hence, my conclusion here is that, and our advice is that, while we know that it is important to stay invested in the long run, and it is important to keep the cost low, it is also equally important to add diversification into our portfolio as a key ingredient so that we can have a favorable investment experience in the long run. Right, I'm also taking this opportunity to wish every one of y'all a very happy new year, and may the year of the dragon bring all of us good health, joy, and prosperity. Thank you.